There's a dangerous assumption spreading through financial circles right now, and it goes something like this. As long as you own some gold and silver, you are protected from what is coming. The logic seems simple enough. Precious metals have historically preserved wealth during times of monetary stress, so holding them now should shield you from the turbulence ahead. But this thinking contains a fatal flaw, one that has caught people off guard in every major financial transition throughout history. Because the reality is that most people who think they are protected are actually positioned to fail, not because precious metals themselves will fail, but because the way people are holding them, thinking about them, and planning around them is fundamentally broken. As we move deeper into the conditions that will define 2026, this distinction is becoming critical. We are not heading into a standard recession where traditional diversification works. We are entering a period where the rules that governed financial planning for the past 4 decades are being rewritten in real time. Debt dynamics are unsustainable. Central bank credibility is eroding. Currency stability is being questioned at levels not seen in generations. And in this environment, the margin for error is shrinking rapidly. The people who survive this transition intact will not be the ones who simply own the right assets. They will be the ones who owned them correctly, sized them appropriately, understood their limitations, and avoided the psychological traps that destroy even well-intentioned strategies. The problem is not a lack of awareness about gold and silver. If anything, awareness has never been higher. The problem is that awareness without proper execution is worse than ignorance because it creates a false sense of security. People believe they have taken the necessary steps, when in reality they have only checked a box. And when the pressure arrives, that false security collapses, often at the worst possible moment. This is why we need to be brutally honest about where most people are getting this wrong, because recognizing the mistakes before they cost you is the only way to avoid them. The first and most widespread mistake is what I call symbolic ownership. This is when someone buys a few ounces of silver or a fraction of gold and considers themselves prepared. They have exposure, which feels like action, but the exposure is so small relative to their overall financial picture that it cannot meaningfully impact outcomes. If your net worth is $500,000 and you own $5,000 in precious metals, you have 1% allocated. That might make you feel better psychologically, but mathematically it does almost nothing. Even if gold doubles, your net worth increases by less than 1%. If everything else in your portfolio declines by 20% due to inflation or market stress, that small gold position will not save you. It will barely register. People fall into this trap because they conflate participation with protection. They hear that gold is important, so they buy some. They read that silver might outperform, so they add a little. But they never stop to calculate whether the position size is remotely sufficient to offset the risks they face. This is not about being extreme or going all in. It is about basic math. Protection requires scale. If the risk you are hedging against is significant, the hedge must be proportional. A fire extinguisher the size of a soda can is not going to put out a house fire. The same logic applies here, but most people do not think in these terms until it is too late. The second major failure point is misunderstanding the nature of the threat. Many people treat gold and silver as investments they expect to generate returns, rather than as insurance against specific risks. This mindset leads to constant second-guessing. When metals are flat or down while stocks are up, they feel like they are missing out. When metals rally, they feel vindicated, but also start thinking about when to sell and lock in profits. This transactional thinking is completely at odds with what precious metals are supposed to do. They are not meant to beat the stock market during good times. They are meant to protect purchasing power during bad times. Judging them by the wrong standard leads to poor decisions at critical moments. The confusion deepens because metals do experience price volatility, which looks like investment opportunity or risk depending on your perspective. But that volatility is not the same as the volatility in stocks or crypto. When gold drops 10%, it is usually not because the fundamental reason for owning it has changed. It is because short-term sentiment shifted, leverage unwound, or some technical factor triggered selling. People who panic during these moves and sell are often abandoning their position right before the reason they bought it becomes relevant. This is not theoretical. It happens repeatedly. Another critical mistake is failing to differentiate between gold and silver in terms of behavior and purpose. Many people treat them as interchangeable or assume that if gold is good, silver is automatically better because it is cheaper per ounce or has more upside potential. But gold and silver are not the same asset. They behave differently, respond to different drivers, and serve different roles in a portfolio. Gold is primarily a monetary asset. Its value comes from being recognized globally as a store of value and a hedge against currency debasement. Silver is a hybrid. It has monetary characteristics, but also significant industrial demand. This makes silver more volatile and more sensitive to economic cycles in addition to monetary factors. The practical implication is that silver can outperform gold dramatically during certain phases, particularly when inflation is accelerating and industrial demand is strong. But it can also underperform or experience sharper drawdowns when economic growth slows or when speculative positioning unwinds. People who go heavy into silver without understanding this dynamic often cannot stomach the volatility. They end up selling during drawdowns, which defeats the purpose of holding it in the first place. The solution is not to avoid silver, but to size it appropriately and understand that it requires more conviction and patience than gold. A balanced approach recognizes that gold provides stability while silver provides optionality, but neither can replace the other entirely. Liquidity is another area where people consistently get tripped up. Precious metals, especially physical metals, are not as liquid as cash or stocks in all situations. You cannot instantly convert a gold coin into groceries or pay rent with silver bars. There is a process involved, whether that is selling to a dealer, using an online platform, or finding a private buyer. During normal times, this process is relatively smooth, though you will typically pay a spread. During times of stress, liquidity can become more challenging. Dealers may widen spreads, platforms may experience delays, or buyers may be harder to find depending on the situation. This is why metals should never replace your emergency fund or short-term liquidity needs. They should sit on top of those things, not underneath them. People who violate this principle often find themselves forced to sell metals at inopportune times because they need cash for unexpected expenses, or because they did not maintain adequate liquidity elsewhere. Forced selling is almost always destructive. It turns what should be a long-term strategic position into a short-term source of cash at exactly the wrong moment. The irony is that the people most likely to need emergency liquidity are often the ones most tempted to overallocate to metals because they are anxious about the future. But anxiety is not a strategy. Discipline is. Storage and security represent another layer of complexity that many people underestimate. If you own physical metals, you need a plan for where and how to store them. Keeping everything at home introduces security risks. Using a bank safe deposit box may feel safer, but comes with its own risks, including the fact that banks can restrict access during times of crisis. Third-party storage through specialized vaults offers security and insurance, but requires trust in the custodian and typically involves fees. There is no perfect solution, only trade-offs that need to be understood and accepted. The mistake people make is either ignoring these considerations entirely or becoming paralyzed by them. Some people buy metals and then leave them in a drawer without thinking about security. Others spend so much time worrying about the perfect storage solution that they never actually take action. The reality is that reasonable security is better than perfect security that never happens. And having metals with imperfect storage is better than not having them at all. The key is to make a decision that matches your situation and then move forward, rather than letting logistics prevent preparation. Another widespread problem is anchoring to past prices and missing the bigger picture. This anchoring bias causes people to wait for pullbacks that may never come, or that, when they do come, still leave prices higher than where they hesitated before. The goal is not to time perfection, but to establish a position while you still can. If gold is expensive at $2,700 and you wait for it to drop to $2,400, but then it rallies to $3,500 without ever giving you that entry, you have not saved money. You have missed the boat. Conversely, if you buy at $2,700 and it drops to $2,400, that temporary paper loss is irrelevant if your time horizon is measured in years and your goal is protection rather than trading. The psychological dimension of holding precious metals is also drastically underestimated. There is a reason most people abandon their positions before they pay off. It is not because the fundamentals change, but because the emotional weight of holding an asset that does nothing during bubbles becomes unbearable. When stocks are rallying, real estate is booming, and crypto is making headlines. Sitting on gold that has been flat for 6 months feels like you are being left behind. That feeling is intentional. It is precisely what makes metals effective as insurance. They do not participate in euphoria. They do not make you feel smart at parties. They sit there quietly, which is exactly what they are supposed to do until the party ends. People who cannot tolerate this discomfort inevitably capitulate. They sell their metals to chase whatever is hot, which means they no longer have protection when conditions change. This is not a minor issue. It is one of the main reasons people fail, even when they start with the right assets. Discipline matters more than intelligence. Patience matters more than analysis. If you cannot hold something through extended periods of underperformance, you should not own it at all, because the stress of holding it will lead to worse decisions than not having it in the first place. The timing question also trips people up. Many people are waiting for a clearer signal before they act. They want confirmation that the crisis is real before they commit to protection. But markets do not work that way. By the time the need for protection is obvious to everyone, the price of protection has already adjusted. Gold does not wait for you to feel comfortable. It moves in anticipation of stress, not in reaction to it. The people who position early pay lower prices and avoid the rush. The people who wait for certainty pay higher prices and compete with panic buying. This does not mean you need to go all in immediately or act recklessly. It means that gradual, disciplined accumulation, while conditions are relatively calm, is far more effective than waiting for a crisis to validate your decision. Spreading purchases over time reduces timing risk and allows you to build a position without betting everything on a single entry point. This approach is not exciting, but it is effective. Most successful outcomes in financial preparation are boring. They are the result of consistent, unglamorous decisions made over time, not dramatic moves made in panic. Geographic and political considerations also matter more than people realize. If all your wealth is denominated in one currency and held in one jurisdiction, you are exposed to decisions made by that government and that central bank. Precious metals provide a way to diversify that risk. Gold, in particular, is recognized globally. It does not depend on the stability of any single country or the credibility of any single institution. This makes it uniquely valuable in a world where geopolitical fragmentation is increasing and trust in traditional systems is declining. But simply owning metals is not enough if they are held in a way that subjects them to the same jurisdictional risks you are trying to escape. If all your gold is stored in a bank vault in the same country where you live and work, you have reduced currency risk, but not political risk. If that government decides to restrict capital movements, tax wealth aggressively, or confiscate assets, your metals may not be as accessible as you think. This is not about paranoia. It is about understanding that systems under stress tend to become less friendly to individual wealth preservation. Diversifying storage across jurisdictions, while more complex, reduces this tail risk significantly. Paper metals, including ETFs and futures, introduce an entirely different set of risks that many people do not fully appreciate. These instruments offer convenience and liquidity, which is valuable, but they also rely on the financial system functioning properly. In a scenario where counterparty risk materializes, or where there is a disconnect between paper claims and physical availability, these instruments may not perform as expected. This is not to say they have no place. For some people, especially those prioritizing liquidity or trading flexibility, paper metals make sense, but they should not be confused with physical ownership. And anyone relying heavily on paper metals should understand that they are taking on additional risks that physical holders avoid. The allocation question continues to haunt people because there is no universal answer. But there are frameworks that work. A reasonable starting point for most people is to think about what percentage of your net worth you would need to protect in order to sleep at night if everything else declined significantly. If you believe there is a meaningful chance that traditional financial assets could lose 30% to 50% of their purchasing power over the next several years, how much of your wealth would you want in assets that can offset that loss? For many people, the answer falls somewhere between 10% and 25% of net worth, depending on their specific situation, risk tolerance, and ability to weather volatility. Within that allocation, a gold-heavy mix tends to provide more stability, while adding silver increases potential upside at the cost of increased volatility. A common conservative approach is roughly 2/3 gold and 1/3 silver within the precious metals portion of a portfolio. More aggressive allocators might move closer to half and half, but that requires the emotional resilience to handle larger swings. The key is not copying someone else's allocation, but tailoring it to your own circumstances and temperament. The biggest failure, however, is not in the allocation percentage or the gold to silver ratio. It is in the failure to act at all. Paralysis is more dangerous than imperfection. People who spend months or years analyzing, debating, and waiting for the perfect moment often end up doing nothing. By the time they feel ready, conditions have changed and prices have moved. The people who fare best are not the ones who optimize every detail. They are the ones who make a reasonable decision and then follow through with discipline. As we move toward 2026, the conditions that make precious metals relevant are intensifying, not diminishing. Debt levels are not declining. Central banks are not restoring credibility. Inflation is not being solved. Political pressures are not decreasing. These structural forces suggest that the need for monetary insurance is growing, not shrinking. The people who understand this and position accordingly will have options that others do not. The people who wait for absolute certainty or who hold token amounts and call it preparation will find themselves scrambling when it is too late to adjust comfortably. The window to prepare thoughtfully is still open, but it will not remain open indefinitely. The goal is not to predict the future perfectly, but to position for a range of outcomes in a way that allows you to remain financially and emotionally stable, regardless of which scenario unfolds. Gold and silver are tools for that stability, but only if they are held in sufficient quantity, with proper understanding, and with the discipline to maintain the position through periods of doubt. Most people will fail at this, not because they lack access to information or because they chose the wrong assets, but because they lack the conviction to size their positions meaningfully the patience to hold through uncomfortable periods, and the discipline to avoid the psychological traps that destroy even good strategies. Recognizing these failure points now, before they cost you, is the difference between symbolic preparation and real protection. The choice is not whether to own gold and silver. The choice is whether to own them in a way that actually matters when it matters most.